Ever pondered over how the Federal Reserve manages to control interest rates for home mortgages? It's a complex dance of various monetary policy tools, all geared towards maintaining stable prices and maximizing employment. Let's delve into this intricate process, breaking it down into simpler, more digestible steps. The Federal Reserve, or the Fed, wields a potent tool known as the federal funds rate. This rate, which is the interest at which banks and credit unions lend reserve balances to other depository institutions overnight, is the primary lever through which the Fed influences interest rates. If the Fed hikes up the federal funds rate, banks find it more costly to borrow money, leading to an uptick in interest rates across the board, including home mortgages. Conversely, if the Fed lowers the federal funds rate, the opposite effect is observed. Imagine the Fed deciding to increase the federal funds rate from 2% to 2.25%. As banks grapple with higher borrowing costs, they pass on these costs to those seeking loans, including those looking to buy homes. Consequently, prospective homebuyers would face steeper mortgage interest rates, making the dream of homeownership a tad more expensive. Another strategy in the Fed's playbook is conducting open market operations, which involves buying or selling US government securities in the open market. This movement of securities affects the amount of money in the banking system, which in turn influences interest rates. When the Fed purchases securities, it injects money into the banking system, leading to lower short-term interest rates. On the flip side, selling securities siphons off money from the system, causing interest rates to rise. Consider a scenario where the Fed decides to buy a substantial quantity of government securities. As banks find themselves flush with funds, competition among lenders can drive down interest rates, including those for home mortgages. The Fed also employs a technique called forward guidance, essentially signaling its intentions about future monetary policy actions. This can shape expectations in the financial markets, indirectly influencing mortgage rates. If the Fed indicates that it plans to keep interest rates low for a prolonged period, lenders may anticipate lower mortgage rates and adjust their behavior accordingly. There's also a tactic known as quantitative easing, or QE. This involves the Fed buying large quantities of longer-term securities, such as mortgage-backed securities. By buying these securities, the Fed directly influences the mortgage market. This increased demand raises the prices of these securities and lowers their yields or interest rates, leading to lower mortgage rates. Finally, changes in the Fed's discount rate, the rate at which banks can borrow directly from the Fed, can indirectly affect lending behavior by banks and consequently mortgage rates. So there you have it. The Federal Reserve uses a combination of tools and techniques to influence mortgage rates, all in the pursuit of stable prices and maximum employment. It's a fascinating process, one that plays a crucial role in shaping the costs of homeownership.